Hi everyone, my name is Piterpakulski. Today we'll continue building a real estate acquisition financial model. Today we will be modeling the loan. At previous videos we were working on house price, down payments. We were setting up the parameters for the loan, the rent price, when we start the deal, what is the time to the first deal, what is the term of leasing contract, if the tenant will drop, what will be the time to find the next tenant. We were modeling the rent, the revenue from the rent. We were inflating the rent. We were talking about operating expenses with their seasonality. We were inflating these operating expenses, each of them with their own speed. Then we were talking about initial acquisition costs, placing them in timeline, and today it's time for us to place the loan inside the project. So first of all we need to let's create a timeline for the loan. So by the way, if you find this video valuable, you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. And at the end screen of this video I will be giving the link to the playlist where all the process of creation of this financial model will be placed. And when this financial model will be finished, in the description of this video I will be posting the links to all videos of creation of this financial model from scratch. So you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. And today we will be talking about the loan. So first one we need to loan inflow. So first of all we need to place the loan inside the timeline. So how it is done? So if this year equals to this year, and this month equals to this month, we are freezing these cells. Then we are putting here 1, otherwise 0. So so this is the moment when we get the loan. Then we start talking about the actual dollar inflow. So this is the amount of loan. we are freezing it. Now I'm extrapolating this formula to the right. Here we can see the inflow of the loan inside our project. This will be the inflow and will go to the cash flow statement. So we are marking it with green. Then loan count, loan period count, loan period count start. So this will be the formula here will be just displacing this value here. So I will be displacing January to February. So this is the moment when we start counting the months of loan. So this will be 0, 1, 0. Loan period count. Now we will start counting the loan period from this moment 1, 2, 3, 4, 5. So if and this value equals to 0 and this one equals to 0, then we will put 0 otherwise. So this will be more than 0, then we will place 1. Then if and this value is more than 0 and this value is less than the period of loan, and loan period is, loan term is 120 months, then we will add 1, otherwise we are finished with, we are stop counting the loan period.
Now let's assume we 60 months of we have 5-year loan. So we can go back here and see how 60 months are now counted. And now we need we do have some grace periods for principal. So first of all, we need to calculate the principal payment.
the principal payment. So we have amount of loan, we have principal payment grace period of 12 months. So we will just add here a couple of lines. Then principal payments times. So how many times we do pay principal? So we take the loan term minus principal payments grace period. So we will be paying principals 48 times, and the principal payment will be dollar per month will be amount of loan divided by this value. So what we will do now, so this is the principal payment. Now we go back to our loan, and here is the principal payment dollar per month, principal payment dollar per month. So if this value is more than 0, and if this value is more than grace period, we will be paying the principal. Otherwise here will be the grace period. So principal payment, so if and this value, if this value is more than 0 and this value is more than, we are going back. So the grace period for principal equals to 12 months. So we are freezing this value. So if this is more than 0, if this is more than grace period, then we will place here the principal payment. We are freezing this cell as well, otherwise 0. So this will be the principal payments. So this is the amount of principal paid. This line will go to the cash flow statement, so we are coloring it with red. Then we need to calculate interest payments. We need to calculate the amount of principal at any given moment in our project. So how will we doing? How will we calculating this? Principal at any given moment dollar per moment. So now we will create the principal, the amount of principal at any given moment. So we will take this value plus the inflow of the loan minus principal payment. Now we will extrapolate this formula to the right. So now we can see that at the end of the loan the principal disappears. And now we need to calculate the amount of interest paid. So now we know the amount of loan, then interest step 1. So the formula will be if, and so if we have a long period at this moment, so this one is more than 0, and this value is more than grace period, which is 6 months, we are freezing it. Then, so if this is, so we are freezing the grace period. Then if the condition is right, then we will take the principal, this line, the amount of principal at any given moment, multiply this on the interest rate. So interest rate is 7%. I'm freezing it, and then I'm dividing this by 12. Otherwise we put here a 0. Now I will extrapolate this formula to the right. So we have 6 months of grace period for interest payments, and then we start paying the interest. So the total for interest will come from here, and now we will calculate the amount of interest payments. Let's go up. So principal payments times interest payments times, so this will be 60 months minus 6, and the interest payment will be dollar per month will be, so now we know the totals for all interest payments. So we have this value, and now we will divide this value by the amount of payments. So this is the interest payment, and the interest paid will be $1 per month. So if this value is more than 0, then yes, so if this value is more than 0, we will put interest payment. We are freezing this cell. Otherwise 0. So here we can see the payments of interest. I will color it with red because this will go to the cash flow statement. So the totals for this line will be the same as this value. And now I will just let me delete these lines. Let me just hide all this data a second. Oh, we just have to leave the deal start as well, so this will be, we will hide this, we will hide this, so we can, for example, now easily displace the deal, for example to June. We can, for example, play with amount of down payment. We can play with grace periods. We can play with the loan term, the interest rate. So now our loan is 100% automized. We can displace the moment when we start the deal, and all these calculations will be displaced in timeline. We can model any grace periods, any interest rates for the loan. So I hope you enjoyed this video. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will be giving the link to the playlist where all these modeling tutorials for this acquisition model will be placed. And when this model, the whole model, will be ready, I will be placing in the description of this video all the links how I created this financial model from scratch. So you can go video by video, tutorial by tutorial, and see how all this how this model is being created. So thank you guys for watching. See you next videos. Thank you and bye.